Hello, welcome members and guests to the Virtual Investment Club of Sacramento. This is Joanne Obata. I'm the president. All of our meetings and stock studies are virtual, allowing us to have members from around the world and the U.S., including Canada and China. We are a better investing model club open to the public. Guests, you'll be muted during the meeting as observers and will have an opportunity for questions and comments after the meeting is over. I'm going to do a brief disclaimer. The stocks presented today are for educational purposes only and are not intended to be a recommendation for buying or selling any stocks. We ask that you conduct your own review and analysis of any company of interest before making an investment decision. The views expressed are those of members and do not necessarily represent those of Better Investing. This meeting may use products or services not endorsed by Better Investing. Now, let's see. So this is our agenda. The next thing on the agenda is Hanny's Treasury's Report. So I will turn it over to you, Hanny.
Okay.
Let's see.
I'll make him a presenter.
You will? Okay, thank you.
Yeah, I did.
Oh, you already did? Okay.
Yeah.
Thank you, Jay.
You're welcome.
Okay. Can everyone see my screen?
Not yet.
Yes.
Not yet.
Yeah.
Oh.
Bernard, you can?
Yeah, I can see it.
Okay.
Treasury report.
I got Roy can see it too.
Okay.
All right.
Okay, I got it.
Okay. So this month's Treasury Report will be very quick because we have a lot on the agenda. So this screen shows what we bought, what we sold, and any deposits that were made during since the last meeting. We agreed to sell 10-cent holdings, and we sold 67 shares at a loss of $136. We also decided to buy IPGP Photonics. So we bought $1,000, roughly seven shares. And then I made two deposits, one last month for $1,000, as we normally do, and also another $1,000 for this month. So in terms of our portfolio now, this is what it looks like, having sold 10-cent and bought more IPGP. And the arrows on the right hand side of the screen are showing the worst performing stocks, and that's Air Lease Corporation is down about 9.4%. Facebook is even pretty much, and Bank of the Ozarks is down about 35%. Our top three performers are Five Below at 154% gain, and Heiko and IPGP Photonics. So we were at the end of last year in November, December, when the market sold off, we were not doing so great, but so far this year we're up now 20% overall on the portfolio, which is, I think, it's recovered quite nicely. This performance graph shows you our cost basis in blue. So this is the blue line, and the red line is our the value of our club shares, and you can see that they were gaining quite a bit. Then we started to drop, and then this is in the period I was speaking about. We pretty much were even, and then it shot up again just at the beginning of this year. So we seem to be recovering, and it looks like we've recovered. If you kind of extrapolate through this point here to this high, we seem to have gone back to previous levels. This is just I apologize for this slide. It's a little bit busy, but I wanted to put everything on one page. So this shows the makeup of the portfolio. We're heavily weighted in the sensitive sectors, And then cyclical is our next. So from a sort of a defensive position, if the market should sell off again, this portfolio might see some volatility.
Really? This
Yes,
is
Bernard.
but what I don't. I'm so sorry, my ignorance. I don't understand. What is a super sector?
That's something that they've defined in iClub. So you have sensitive sectors that are sensitive to the economy. Then you have the cyclicals that are usually tied to commodity price. Defensive sectors are more sort of consumer staples. So they've divided the sectors into these broad categories, and they call them super sectors. But if you look here on the right hand side, you'll get a better sense of kind of what makes up that sensitive super sector, and we have a lot in technology and industrials. So and then you can see at the bottom here the companies that make up those this maroon and I guess purple color. So you have Skyworks, Lam Research, IPG, Entergy, Tencent we sold. So this is not correct anymore. I'll have to update that. It didn't update on the report for some reason. And Facebook and so on. So another thing to look at is just the sectors that are not represented. So financial services, it says we don't have anything in financial services, but that's what Ozark is, and I don't know why it shows up here in industries as unknown, but it's definitely in financial services. And then consumer defensive, we don't have anything. Energy, you could argue that Algonquin Power is energy. It's a utility, but it's they also have some thermal generating assets that would be considered sort of in the energy space. So this just gives us a sense of where the portfolio is. In terms of companies, I think we're pretty good. We don't have a lot of concentration in one particular company. Skyworks is at 11%. That's our one of their largest holdings, and we have about 11% in cash. So, and then I guess the next one after that would be Facebook, or Disney and Facebook at 8 and 9%.
I believe iClub got the super sector designations from Morningstar. Morningstar came out with it about a year ago, and I know iClub has been touting it, but I believe this is a Morningstar alteration.
Okay, it kind of makes sense. That you're dividing things into cyclical, consumer defensive, sensitive, and so on. So it's not a bad definition. I think it's if last month in the Treasury's report, I showed a graph of the economy versus some of these sectors and where one should be during different phases of the market cycle. And so I think that the super sectors is a good way to kind of look at where you might want to rebalance a portfolio depending on where we are in the cycle. So that's the report for this month. Any questions?
Oh, thank you.
Thanks, Bernard.
Oh, Henny, I really like that film you recommended, Forks Over Knives. Thank you.
Oh, okay. Did you see it?
Yes, I just watched it. Very helpful.
Oh, okay. Okay. I saw that in the doctor's office. Sorry.
Is that the plant-based diet one?
Yes. Yeah.
Oh, I have watched that. I read a book too. I'm on it.
Okay, next we have the stock study with Hanny, Mina, Jay, and John, our guest, and they'll be presenting PACW to challenge OZK, our Ozark.
Bank of Ozark.
Is it Bank of Ozark?
Yes, that's Bank of Ozark.
Okay.
So I'm going to let Henny to start with the discussion, the introduction to how do we, our decisions. So why do we do challenge to Bank of Ozark, and what's our conclusion to present Pack of West?
Okay.
And then John's going to present Pack West, but Henny is going to start
All right.
introduction.
So I'll just start very quickly talking a little bit about what regional banks are. And so let me just blow this out a little bit. So regional banks are smaller banks with revenue coming mostly from sort of normal banking activity as opposed to wealth management or commercial type of uh, uh, investing. So they focus mostly on consumer and small business loans, and they don't have a national presence, but they're usually in a specific state or region. In the United States, and I'm a Canadian, so if I get this wrong, please help me out. There's kind of 5 regions that are defined. So we have the Northeast, the Southeast, the Midwest, the West, and the Southwest. Those are the if you look at how sort of the industries, if you're doing any sort of bank analysis, they refer to these 5 regions, and banks will fall into one of these 5 areas. There's also regional sort of national banks. So these are some of the big banks like Wells Fargo or Citibank or something like that have presence in these areas as well. So that's a 6th classification, which is the large banks, but they put them in sort of in their own category. So just a quick industry outlook. So far this year, the regional banks have been outperforming the broader market, and there's a couple of ETFs that track regional banks. This KBW is one, and there's another one, KRE, which is it's a wider ETF. They both have outperformed the Nasdaq and the S&P 500, and regional banks have a number of sort of things that'll help them, regardless of whether the Fed raises rates or not, or how the economy behaves. They're especially the regional ones, because they're not as sensitive, I guess, to the overall economy as some of the larger banks. But they also are, because they're smaller, they're more nimble. They're investing in technology. And they have a lot more flexibility in terms of regulation. They're less hampered by regulation. So they will, going forward, they're expected to do well. And so regional banks again are between about somewhere less than 250 billion in assets, and they, again, as I said, they're less. They have less stringent regulations, so they don't have that added cost for compliance. So the sector is oversold, and it's trading at some pretty good discounts relative to fundamentals. Most of these banks have very strong balance sheets, and they have pretty good profitability metrics, but their PEs are, about 64% of the S&P average multiple, which is about 15 times. So most of these regional banks are trading at a forward PE of about 9.6 to 10, and they have a lot of because of the the Trump tax breaks. They're doing a lot of stock buybacks plus their dividends. So their overall sort of yield, if you look at both of those things, is about over 10%. So they're not only are they do they give a dividend in a lot of cases, but they're also buying back stock with some of the tax money that they able to realize. This is just a quick overview of what performance to date, year to date, relative performance. So we've looked at about 5 regional banks, and I'll show those on a quick spreadsheet after this presentation. But one of the ones that excuse me, we decided to bring forward is Pacific West, Western Bank, and we compared that to Bank of the Ozarks, which we currently own, KRE, which is the ETF that tracks the regional banks, and then IVV is another ETF that tracks the S&P 500. So you could see that from the start of this year, Ozark has been doing well, but that's because it's been doing quite poorly. So it kind of is starting to move up. But if you look at the 3-year performance, which I'll show you on the next slide, it hasn't been doing all that great. The KRE, which is the index, has been doing much better than the S&P 500. That's the red line, and the S&P is the green line. And then the bank that we'll be presenting today is the black line, and to date it's been doing about 23%. So this is a 3-year relative performance, and again, you can see that KRE, the ETF, has done quite well, up about 50-something percent, 54%. S&P 500 in the same time period is 46, 47%. Ozark in the last 3 years has gone down about 20%. So it's as John and Jay will point out, it has attractive PE, but you can look at the 3-year performance and see that it has not really kept up with the broader market or the industry ETF. And this is just this chart shows the 2 regions. So the West region banks, and that's where PACW is, and then the Northeast is where the Bank of the Ozarks is. And you can see the performance again on the total return, say 5 years here. For the Western banks, the average is about 50%. The Northeast banks are sitting at about 34%. And then 1-year returns are down, but year to date is positive at 17 and 13. But again, Bank of the Ozarks in the same 3-year time period was down about 20% or so, as you can see here. So it hasn't really kept up with the banks in its region, and certainly not with the Western region. So that's just a quick overview. Now let me see.
Can you go back to your map, slide 2?
Sure. This one?
Yeah, I think you have Bank of the Ozark wrong. You have it as Northeast, and
yes.
It should be Southeast.
Oh, okay.
Arkansas.
Yeah, Arkansas. Okay. That's my ignorance of American geography.
That's okay. You probably learned that from the NCAA, which believes University of North Carolina is in the Midwest. So,
well, the reason I had it there was because I was looking at ZACS, and that's where they had it. They had it in the Northeast. So I'm not sure why they did that, but that's a good catch.
I think Bank of Ozark even has some branches in California and in New York. They're spread out.
California, only one. Only one in California. Yeah, they do have some.
Yeah, so that's an interesting point, Bernard, because I'm not sure how then they classify them, within these regions, because, I guess it depends on the concentration or maybe where their head office is. I don't know.
Mm-hmm.
But quite a few of them, you're right, like are spread out in different regions. So I'm not sure how they end up being classified in one region versus the other. So let me just pull out. I apologize. I didn't have this. Where is it? I didn't have this set up, but
Stock studies.
yeah, 2019. Is this it, Jay?
That's it. That's it. Yes, that's it. Okay. I was surprised you still use your desktop Google Drive.
I could use the other one. It's
That's fine.
yeah,
But because Google
kind of
stopped
slow.
supporting it. Yeah. No, you have it. Open it. I can see the tab.
Oh,
It's
here
on.
it is. Yeah.
There you go. Yeah.
Here we go. Okay. So this is just a spreadsheet. We identified these 5 banks: Western Alliance. I can't remember the name of this
I forgot
one.
ABCV is something about America Bank.
Yeah, it'll come to me in a sec. Eagle Bank Corp, Pacific Western, and then Ozark. So what we did was we used, it's opening up another one. We used this spreadsheet that was developed by Roth Meredith, and there's a number of checks on here, and based on filling in these this table, we came up with PACW as the one that we should present. And I do have to say they're all really close, and they have a lot of the metrics are very similar. But so it was kind of hard to pick which one to go with. But after a lot of debate, this is the one that we thought would challenge Bank of the Ozarks. You can see here though, when we did the valuation, so price to book value and price to tangible book value, Bank of the Ozarks is relatively inexpensive, but if you recall the performance graph, it hasn't performed very well, so it could be considered a value trap. So I'm giving away, or I'm showing my bias, and John is still to present, so I'll just keep quiet.
Just keep with this for a second. Yeah,
Sure.
I want to point it out that the potential returns, another reason that we want to present PacWest is look the 5 SSGs, that one of the things because the fundamental wise, they're very similar and they are doing very similar. So the performance wise, fundamentals, they are very close. But we look at the potential returns of who gives the highest, which PacWest does give the highest based on our SSGs. So that's another reason why we present PacWest. So, okay. So next, we're going to have John to present. John, I'm going to make you presenter to show your first cut. Just want to let everybody know this is John's very first presentation, and he is our guest. So, okay, John, take away.
Okay, thank you. Thank you for letting me do this. I'm just going to try to keep it brief. I don't want to overtalk and not really when I shouldn't. So mostly I'm just going to read this and explain a little bit if I can. So this first prompt here, I assume you've all seen this many times, but we decided to go through, Jay and I decided to go through the 5 companies that were there and look at each one regarding actually not these per se, because banks are different. So we used the one for banks, the one that was just mentioned in that spreadsheet that Hanny brought up and Jay was talking about. So we looked at those 5 companies again, we were just said. And overall, we chose to do PACW to recommend that one. So looking at strength of management, the return on average assets, greater than 1.5% is considered excellent, and all are above that. PACW is 1.6. You can look at the spreadsheet. I'm assuming everyone has added to it. You can look at the spreadsheet to see what I believe you can look at there. Yeah, you can, right around there, to see what each one exactly is. Revenue sales for banks equals non-interest income plus interest income. All are trending up, so that's good. That at least that the PACW is as well, but they're all the same in that regard. PACW's last 5-year sales is 12%, last 8-year sales is 27%. Jay crossed out the recession years, 2009, 2010. If you were to go into the study and uncross these out, it would just I'll just do it right now. Oh, whoops, don't know how to do that. So I'll just go back. So if you were to go into yourself and cross these out, or let these be counted, it would make a big difference in like how it looks. So we decided to not count those because the recession skewed it. That was our rationale there. Okay, loan quality, loan loss provision expense ratio needs to be less than 1%. All are consistent in the last 5 years and less than 1%. Just to go over here a little bit. So it tells you the formula for what this means. Loan loss provision expense, I guess, so that's like their provision for losses on loans, is what I think that means. And then you just divide it by the total loans and multiply by 100. And so these are all below 1. That's what we saw. Number 4, non-current loans and leases should be declining in less than 1%. This metric is the indicator of future loan loss expense and spot future problems. All below 1% and trending downward in the last 5 years, so they're all similar again. Relative PE, look for it to be below 1. You want the, and I think that the formula for that is right in here as well. Yeah, current PE over 5-year average PE. So obviously you want the, if at all possible, you want the current PE to be less than the 5-year average, which would make that equation, that little calculation equal less than 1. So they all are there as well. And use book value and tangible book value to identify banks at a fair price. This is number 6. PSCW tangible book value is 2.19, and Ozark tangible book value is the lowest at 1.31. The other 2 tangible book values are above 1.9. Now you can see the book value. We also didn't realize this until late, but the Mr. Meredith notes, yeah, Mr. Meredith's notes talks about looking at book value as well as tangible book value. Tangible book value is kind of, you rely on that if the book value is not crystal clear for you. But you can see apparently with PSCW, just one thing I want to mention is that it looks like they have a lot of intangible assets for some reason. This figure right here, I believe, was just pulled. I found it on the financial statements, these tangible book value per share. I found that on the financial statement. So, and then this book value, I think, was probably calculated based on, I believe you calculated this, Jay. And,
Yes, the shareholders' equity divided by number of shares outstanding.
Yeah, so it's just you take the assets minus the liabilities, equals the shareholders' equity. You divide that by the shares outstanding, gives you the book value per share. So, so it looks like that's one thing that I guess I would note, but we have to. I mean, probably. Well, I don't know. I'll just move on. Stop elaborating.
I think it's just to check the valuation. Just want to check the price. So there's like Roy early on was asking for bank. Yes, one thing is we want to look the PE lower than the average PE, which they are. All of these banks are. Second thing is that we look the book value. So make sure their price to ratio is about 1. The third thing is that it's just a double check. So based on Meredith, he's a bank examiner. He's just saying in today's economy, the tangible book value, a book value should be about between 1.5 to 1.75. He's saying that if the company's business strategy is to buy acquisition, so you want to make sure that the tangible value is less than book value.
Yeah, that's because of goodwill. So
Yes,
when
because
they
of goodwill.
Right. Oh,
when they
that's
acquire,
Yeah.
when they acquire, there's goodwill involved.
Right.
Yeah, they got to get goodwill. They don't have to, but I mean, usually almost every single time get goodwill. Yeah. Okay.
Right.
All right.
Okay.
What I remember from Meredith, he said that the best indicator was the return on average assets. And when I look at that, Bank OZK comes out the best.
No, they all look.
But
Bernard, we listed here ROAA number 9. So
yes,
it is the best, but this is just one of the indicators. Is a 2%. It's all of them. He's saying everything if it's greater than 1.5%, it considers good. So this is one of the indicators, ROAA. So we looked at everything. So what John's
Well,
doing right now is that we looked at one by one. Just want to make sure all these metrics measures up, and not just like one ROA is critical, but just one aspect.
the other thing, Jay, is that
Mhm.
is the trend of return on average assets. So we looked at the trend, and you can see that a couple of them are trending down,
Trending down, yes.
and there's only 2 that are trending up. One is
I
flat,
think
2 are down.
Bank of Ozark is trending down. Yes, Bank of Ozark
John, if you go back
ROA is
to
trending down. Yeah.
John, if you go back to the spreadsheet,
Okay, yeah, sure.
yeah, you'll see there's the number 8 return on average asset trend. So both Eagle Bancorp and Bank of the Ozark are trending down. Ameris Bancorp is flat, and then the other 2 are trending up.
Mm-hmm.
So it's kind of a combination. It's very difficult. They're so close to each other in a lot of.
Mm-hmm. Right.
Okay.
Okay.
Okay. So debt to capital should be less than 35%. They're all less than 35%. So again, they're all similar in that regard. We did want to anticipate some questions, I guess, with regard to, let's see, there's a sudden drop, or so to speak, and right here. I guess that's better. Oh, so it's up here, right? Here's what you meant, Jay, right? This increase right here.
2018.
That the increase, yeah. So the increase is due, we think, to an acquisition. One of the acquisitions they made that increased their debt. So, and that's why. But it is so it does say up for this last year is up as the 5-year average, but it is reasonable, and so that's what we got there.
So yeah, they had acquisition in 2017. They acquired a company, LA.
Yeah. And then the bank size is based on total assets, and then the assets are listed right there. Medium size is, I guess, is 10 or above, and below that is small. And so those 4 are medium, and EGBN is a small size regional bank.
Mm-hmm.
And then just one final thing there. Based on the SSG comparison, PacWest gives the highest potential return. That's again what we saw in the right here. So just going based off potential high return on these used to the SSG model. It looked like PacWest had the highest one. So okay, so the company is, there's a holding company right here. I'm on this one right here now. The holding company has one subsidiary, so it's just a holding company that has the Pacific Western Bank as the subsidiary. And I think we copied this from the 10K or something or maybe something like an annual report. They provide lending and comprehensive deposit and treasury management services to small and medium-sized businesses conducted primarily through their 74 California-based branches and 1 branch in North Carolina. They also work with middle market businesses and venture capital private equity investors throughout the U.S. So they have I guess obviously they're probably pretty much mostly in California for their branches, and they do these 3 lending, comprehensive, and for businesses. And then there's also 2 arms that are national. This middle market businesses, try to work with some of those, and venture capital private equity investors, and that's throughout the U.S.
Do you want to explain what Treasury Management Service is?
I keep forgetting, so I just have it up right here. So, but I think it's basically, unless someone knows that can explain it better, probably. But I guess basically it's for the businesses themselves to manage their liquidity, their customers to manage their liquidity, so that they're able to make have expenses at certain times without having to break a contract with regard to some sort of CDs or whatever. I don't know, something where they're able to use their money in an efficient way. And so that's basically what I think it means. There's a whole Wikipedia entry on it. So yeah, that's treasury management as far as I know.
Okay.
Okay. And projected growth rate for sales is 8%.
Do you just want to show us the SSG and why you are talking about these to save time?
I don't know. Why don't I can stop here if that's all right. If that's all right with you, and you can do that.
Stuff right here.
I gotta do more webinars for like.
Okay, that's fine. So can you? Oh, okay. Okay. Maybe you can explain the future growth because that's part of your study.
Yeah, sure,
So I'm going to help John to talk about the SSG because this is his very first time. He's really brand new to better investing. So I'm going to. Should we look? Do you want me to look at my screen or your screen?
Oh, your screen's fine. I can look
Okay.
at this.
I'm going to make myself presenter. Okay. So I'm going to show you the SSG for Pac West. As John mentioned, we crossed out 2009, 2010 because the data would be skewed because they were doing the recession, was on negatives. So for the future sales that we forecast 8%. The reason was that we looked up, Pac West first cut. So we looked a few analysts' projection like Zach, Yahoo, Morningstar, Newton's. They gave about 10%, and BI analysts gave 2.6%. So that the number is from here. And we really did not find the company's guidance, so we decided to just go say if we just even below analysts' projection. Another thing is the value line. This is something that Roy has a rule. He normally doesn't invest any companies that if it's not in value line. He made exception. Roy, I remember you made exception on OLED back then. You and I were doing stock studies. So this company does not have. It is in value line, but only have HTML data, which very brief, doesn't have a analyst write-up, like a quarterly write-up. So I cannot find anything in value line. So we just projected at 8% for future sales. And for the earnings, what we used the preferred procedure, gross calculation, and there's no really judgments. I check against each tab that we just go with the numbers that have in here. So last time looked at
looking at that, your tax seems a little high because with the Tax Act, I think more of them are down around 21 now, which would give you a higher EPS.
So you are saying even though listed here 26%, we shouldn't?
It's possible with banks, or at least this bank, maybe they didn't get the full benefit, or because their taxes are really high, 40 and 37 and that. So maybe 26 is the new normal. But when you look at a manufacturing company, the new normal is around 21%.
Mm-hmm. So it's already really coming down.
Because it could be financial banks are different. So I just want to point that out. I'm not saying change it, but.
Okay. It is lower compared to prior years, lower about 10%, but this, yeah.
Yeah, okay.
Okay.
And I've moved away from that. I now will look at companies that don't have the full value line report.
Okay.
I'm nervous, but I can do it.
Yeah, I know you did an OLED. That's what I remembered. That was the only one exception you made back then. So for management, pre-tax profit and return equity, they are going up, which is good. Debt capital is actually up back 2018, which John explained it because the acquisition. ROAA is going up, the trending up, which is also a good thing. We want a number to be greater than 1.5, which they are 1.6. Okay, the PE, the high PE, so we give 15. What we did was that we're looking for the trend. So, and I noticed that 2016, 17 is fine, trending up, and the last year was trending down. And so we decided to just give the lowest based on the last 5 years. For the low PE, also we picked the lowest in 2018, but we really did not use that calculated price. We decided to take another, based on the 52 weeks low, we take another 10% off. So we gave a $28. We project the next 5 years, the low price is 28. This company also pays dividends. And based on that, it gave us the highest return at the 18% with a high PE, and the average PE will give us about 14% return. We can also look at the ratios. That's the relativity value, that's 68%. Projected value, I did not do this calculation. Do we need to do those? These are new. Roy, do you know if we need to do this? Anybody? No?
That's, yeah, I'm not sure. It is new, and I haven't studied it as to why they have that.
Okay. So
Other
PAG
than
ratio.
we ask for relative value in our reports.
Yeah, we did. Yes. We actually have it in that notes, relativity value, which is here. 64, 65. Yeah. So it depends on your calculation.
Yeah, it's
Oh,
just
yeah.
showing you. It's just showing
Uh-huh.
you the current PE versus the average 5-year
Average
PE,
PE. Okay.
and then the projected relative is the current
Projected.
the projected versus the growth. I think.
Right. Yeah.
Um,
And the PAG
so,
ratio.
yeah, the PEG ratio.
Yeah.
Sorry.
1.5.
So I think these are calculated automatically once
Yes.
you
Okay.
fill in your.
Okay. Okay. So that's the SSG. You guys may also want to see the trend, the trillion and quarter data. So it seems like 2018 is a good year for them. They also have some negative earnings back 2016 and then doing better, going up. So that's that. Okay, so any questions about PacWest? So we do recommend a buy if we want to replace Bank Ozark, which I'm going to give Bank Ozark a 10K report. So Joanne, do you want me just carry on to give the Ozark a 10K report?
Yeah, so we can do a comparison.
Okay.
Wait, I have a couple questions.
Okay, Megumi, go ahead.
So maybe I missed it, but how come there's no data available for this particular company?
What data?
Well, you said that.
It's a value line.
Yeah.
Oh, value line. We don't know. So value line is another independent financial company service. Is that what you're talking about, value line? I want to make sure I understand her question.
Well, you said that you can. No, I think it's more like the financials. Did you say the financials you couldn't find for this company? You didn't say that. Okay.
I didn't say that. I said that we cannot find in value line the PDF quarter report write up.
The analysis
analysis. Yes, that's correct.
Okay, and then my second question is actually this is actually for Roy. So what made you move ahead with picking companies that aren't featured in value line? I'm just curious.
Well, they're usually the small companies, so they're not covered by the regular report. And but you can find information. In fact, I'll be presenting that in a NorCal webinar in a couple of months. But what it allows you to do is find a great company before all the analysts find it, and then when they jump in, that tends to make them go up in price.
I see. Okay, thank you.
Right. So,
Roy, that sounds like a good education topic since we haven't had one in ages.
Okay.
Yes. So Roy mentioned about small size company. So normally we look at the sales, right, to determine the size. So if just look at this company itself, sales is only like a 1 billion, it will be small. But however, based on Meredith, for banks, we should look at the total assets. So the total assets are 25 billion. So greater than 10 billion, consider this as a medium-sized regional bank. But probably value line evaluate same way as us. So consider this is a very small bank, so they don't have write-up.
Yeah, I don't know how many regional banks there are in the United States, but I think certainly over 1,000 or something. And so I don't think they could, do a value line for each one of them. That's probably why.
Mm-hmm. Even if they have a bank Ozark, because it's so small bank for them as also considered small, they don't have a full write-up as well. Not like other companies. Yeah, they're very brief. Like they don't have any projections basically on the PDF on the value line, even for Bank Ozark. Okay. So for Bank Ozark, I want to highlight their sales revenue growth. As I mentioned that, John did actually. Revenue consists two parts for bank: non-interest income plus net interest income. So I show the formula and I listed quarterly. The fourth quarter revenue increased 4%, but non-interest income decreased about 9%, and net interest income increased 6%. Versus annually, revenue increases 6%, and a non-interest income decreased 13%, and a net interest income increased 9%. So I also show in here my notes here, kind of explain what considered as non-interest income, what considered as a net interest income. So net interest income is kind of like earning assets, like a loan, investments, all those kind of things.
Non-interest income is fees that are charged.
Non-interest income is considered service charges on deposit accounts, like
Yeah.
trust income, like insurance, and other sort of income from purchase loans. So I just grab those from their financial report to explain the difference. Total current assets and liability ratio. I don't know how this is going to help us and determine, but anyway, I calculated it's about 1.2 to 1 from 2018 versus 1.3 to 1 in 2017. For free cash flow for this company, I don't see specific call out, say fresh, free cash flow. Instead, they have cash and cash equivalents beginning of year to end of year. So this is what I listed here. As they show that decrease 150,000 from the beginning of the year. So my question is free cash flow is equivalent to cash and cash equivalents? I'm not sure. So that's what I have. About the SSG, the 10 years growth is about 24%, 5 years growth is about 32. So last year, we projected the SSG sales forecast as a 12%. So this year, I decided to cut in half because in the last 3 quarters, they did not perform very well. The earnings are negative. I also went to check analysts' projections. Zach gave 12%, Yahoo gave 12%, Nasdaq 2 years forecast is 11%. Morningstar gives about 5% for 2-year projection sales. So I just decided to cut in half, see what happens. For the earnings, and last year we gave 12%, and this year I'm using the preferred procedure to give 7%. So before I'm going to show you the management on the SSG. Yeah, they are trending down. Well, the debt is down, which is good, but for pre-tax profit and return on equity is trending down, which is not a good thing. I don't find next year guidance. What I really find the guidance only for the loan growth. I don't know if that really, this is meaning that it's a very small portion of it, right? Well, I guess bank is making money from the loan. I don't know. This is what I found. I'm not quite understand what non-purchase loan growth uh in the mid-teen takes into account what they describe in the manager comment. So yeah, I don't understand what that means, but I don't find a specific percentage gave to me the what their guidance will be for the next year. They have not had any acquisition since 2015. But recently they do have a couple of news. The latest news in March is that Ozark Labs, which is a division of a bank Ozark, recently was named one of the best place to work in financial technology, according to the American Banker. So this is gave them the second consecutive year that Ozark Labs has received this award. Okay. So their chief operating officer explained what Ozark Lab function is. It's like a fintech focused on developing next generation tools to make banking convenient, fun, and secure. That's just his word. I copied.
Jay,
Yes,
I
Bernard.
remember I used to go to their conferences, and one time George explained when they're making acquisitions, it helps if their PE is higher, and it makes it easier to make acquisitions. And I guess one reason they haven't made acquisitions lately is because the PE has been much lower.
This also leads me to talk about their growth as expansion. Actually, they talk about the management have talked about they are going to focus on organic growth. Still will be their first priority. So they are going to do de novo branching strategy, meaning that they are going to will increase the market in their banking offices for their metropolitan areas through the across the United States, and also the states that currently do not have any offices. So this is their focus right now. They did not really talk about acquisition, but they really talk about that organic growth will be still their priority, growth priority. So second news was back in January this year is that they hired a chief deposit officer. So apparently this person had some success rate, and he recently led deposit pricing for a 110 billion consumer deposit portfolio. So he used to work at SunTrust Bank as a financial manager. He also worked a Wells Fargo as well as a marketing database analyst. So this hopefully will help the company in that deposit lending business to deposit strategy, helping them to work on deposit growth or deposit pricing. So when I finish listening to the earnings calls and management comments, I made a recommendation, say hold, but I will leave the club to decide based on Henny's presentation, show you the performance of this bank. Yes, it is true last 3 quarters that the company doesn't perform well. As a matter of fact, that we lost about 35% of our holdings. We do have 35% of a paper loss. I think I'm just going to let club decide whether we should have purchase PacWest to replace Ozark, or we add on. I think it's a club decision. So I'm fine either way.
Well, in my opinion, there's not enough difference to warrant changing. And there may be a bad performance by Bank Ozark in the past, but I think it's still a good growing company. I think the prudent thing would be to hold for a while longer and see. I don't think there's enough difference to make a trade at this time.
Based on Henny's presentation, that showing West Bank's returns a bit higher than East Bank, East Region Bank.
But not much.
So
Not much.
So why don't we have this discussion when we get to the whether we buy or sell stocks?
Okay.
Okay, let's have Hanny do his.
Who do I give control to?
Oh,
Who's next?
Is Hanny going to? You said he was going to present something, or is he done?
no, I'm done. I'm just going to
Okay.
do Algonquin Power at the end.
Okay.
Okay, so
are
Roy
you
then.
done presenting your stock study?
So
Sorry?
what's on? Yes, we did.
You're finished.
We're finished.
Okay.
So what's on the agenda? I can't remember. I don't have agenda open. So
Okay. So the
Send it
next,
to me.
okay, Roy.
Yeah. Roy is going to do the quarterly report for HEICO.
Okay.
Okay, do you see my screen?
Bank of Ozark. Yes.
Yeah, I just wanted, because I looked it up, and it is headquartered in Little Rock, Arkansas, and they do have a branch in New York and in California, but everything else is in the South. So I don't know why Zach's has that. So it'd be a good question to ask Zach sometime. Anyway, let me get rid of that.
Oh shoot! I forgot to show you the SSG for the Bank of Ozark. Do you care? It is a buy, but anyway, that's fine.
You sent it out to us already.
I did. I was just saying, showing you at the meeting right now.
Okay, do you want to show that, or should I go on with my presentation?
I don't know, Joanne. What do you think? I think it's fine. I don't have to show you guys.
Okay.
It is a buy, but yeah. Anyway.
To start off with, this is the first quarter of 2019. It ended at the end of January, and you can see that on the SSG, the sales growth projections last year, and for the annual report, I had 12 for sales and 15 for earnings. And you go over the next column, the current one, they're a little higher, and I'll explain why. When you go down to the sales growth, it exceeded the 12 by sales growth by quite a bit, and pre-tax profit and earnings per share by a whole lot. And reading the various reports, HEICO's doing real well, better than expected. So I bumped it up a few points to the 14 and the 19 going forward. The current PE is 46, which is up a little bit from the annual report. The average PE 31.9 is the same. So the relative value is a 1.4, which is exceeding the 1.0. And so if I were going to look at this for purchase for new, I would say no, it's too rich. But we own it. My upside down ratio is 2.0 to 1, so it's in the solid hold. The annual return is only 7.6 using the average PE, but when I show you the SSG in a moment, maybe I'm too conservative. We can discuss that. But one of the problems, I'll call it a problem, that I have with this company is they don't really talk about the bad things that could befall them. So you have to ferret it out. And the major one that I did find was they're hurt if airlines retire their planes earlier than normal, and that's a aeroplanes earlier than normal. That's a quote. I should have put quote marks. That's how they spell airplane. Anyway, because what this company does is repairs and upgrades airplanes. So if they're getting brand new ones, then there's no customer for HEI. But for the most part, they're keeping their planes and maybe extending the life a little bit. And now with all this fiasco with the Supermax 737, they may be hanging on to their planes a little bit longer until that's worked out. So they seem to have a great supply of customers and planes to upgrade. And something that was interesting this quarter, they were instrumental in 2 space shots. One from Israeli, sent up a moon lander, and Japan sent a probe to the Ryugu asteroid, which I have no idea where that is, other than it's higher than Mount Everest. So they're pretty broad. It's not just repairing engines on airplanes. They're doing a whole lot of other work. They increased their dividend by 25%. It's still modest, but they keep growing. So as long as they are able to provide an increasing dividend, that should hold a lot of owners. So as you can see, I have it as a hold. I submitted the value line, which is interesting because usually we give our reports and then a couple weeks later the new value line comes out. Well, because this is March and the end of the quarter was the end of January, we were able to get a brand new value line. And as with most stocks, they took a dip in December, but they've recovered quite well. They're back to what they were before the dip. Their earnings are up. In the black, it says they're generating strong organic sales growth. They also are bought 2 companies, and they seem to be growing through acquisitions a lot and have been. So this is nothing new. But even with the acquisitions, they're also growing organically. And it value line is given a really good report, and timeliness is now a 2. So here's the SSG, and you can see how it's going, LA to Maine quite well, up fairly straight and parallel, although the earnings took a big jump, and I reduced the amount of earnings because of the Tax Act, but they still were able to come in quite well. So, and you can see this percentage change for this last quarter was 15.3% sales and 48% earnings. The pre-tax profit is up, the percent earned on equity is up, and debt is 28% this last year, but it's been going down from the previous year. And on those acquisitions, one they used cash and one they used a really low interest rate to borrow for purchase. So it seems like they're paying off the higher interest loans and borrowing it cheaper. Here is, let me go back. The high PE is 38 on average, and it's been going up. So I could have chosen higher. I was trained don't go above 30, and so that's as high as I wanted to go. But if we did put it closer, like 35 or so, we might be close to a buy, but it still would be a strong hold. For low price, using the 25% and the low PE or low earnings, come up with a 50, which I thought was too low. The current price is 92. I'd have to drop like 45% or more. So what I did is I used the 52-week high, and I heard Jay say that she dropped hers from that by 3%. I haven't done that, and I don't see a need to do that. So I'm using the 67.3, and the downside is 2.0 to 1. So anyway, that's the quarterly report. They're doing well. They seem to be expanding, and I think it's a solid hold. Any questions?
Thank you, Roy. When did we purchase this?
I'm not sure.
That's
Couple years
couple
ago.
years ago. Couple years ago.
Yeah, we've had it for a while.
Yeah.
Yeah.
Heckle. Mm-hmm.
Okay.
Oh, so do
Yeah,
you want me?
as
Yeah, go
Haney
ahead.
showed, we've done well with it. So
Yeah. I think was me and Roy, sorry, Tom, we just started stock study. We found this company. Tom, remember that? You and I met at the
Yes.
Starbucks and we found this company and we're going to look at another software company but didn't do well. But Heckle looks good. Heckle looks good, so we presented a couple years ago.
Okay.
yeah,
So
Tom comes up with some great ones, and so do you.
yeah, thank you. Yeah. So do you want me to show Bank Ozark SSG?
Okay. You seem like you want to. Go ahead.
I don't know because it's
Yeah, just do
10K,
it
kind of like it's
quick.
required. Okay, I'm going to do quick. So, and I give 6% as I explained that cut in half compared to last year's projection, and use default procedure. Default preferred procedure to let me look at tax very quick. Yeah, they also kind of dropped the tax about from 2016. About 12%, and compare last year also another 3%, lower another 3%. But anyway, so for the management, as I mentioned, it's trending down. Only good thing is the that's trending down. Other than everything else is trending down, including return on average assets. Even though 2% is a very strong number, last year 1.91 is really good indicator. But just compared to prior year, it's the trend is going down. But still, like Bernard said, Ross Meredith said anything greater than 1.5 is considered very excellent company, excellent in that industry. And also about high PE, I'm taking 2 points even lower compared to 2018. And that gives $62.40. For the low PE, I give low PE as a 12, and that. But the forecast low price is going to higher than the 52 weeks low, so I decided to just use the recent market low price, $21. This company also pays dividends, and the return still will give about 17% using high PE and a 15% if it's average PE. So what I want to show you is the quarterly data. So looking for the trend. So we know that last 2 quarters they did not do well. and earnings is really negative in the last quarter. But it's not as bad as what I thought, compared to some companies that have so many negatives. We know the
Jay,
fact. Yes, Bernard.
how about there's one page earlier where you can visually see this. Uh, in your report here, sales and earnings, the one page earlier than what you have, you can visually see the earnings and say that one, yeah. And why does it change like that? I don't know.
What do you mean?
Well, it seems like in
Oh,
12
sorry.
17 or December 17, uh, the earnings went pretty well down, and sales started down in 6/17. I mean, according to that visual, that
Hmm.
the next page.
Oh, that's different. That's a quarterly data. So what
Yeah.
you're looking at is a annual data. So this is a quarterly data. So that's a quarterly data every quarter. So this is a trailing quarterly data.
But as I recall, it went down because they had some bad loans, and then a couple of their officers
One
led, I think,
officer, yeah,
in
left the company.
disgrace.
Yes.
So, I think it's a real iffy company myself. But
Right.
they
One
had
quarter.
they had those um, bad loans come in.
I think the back loans was the last quarter. I think the third quarter, something to do with JCPenney and the Sears were being closed. Something to do with the mall. I have to go back to look at my report. I forgot to do it. And then maybe before that or after that, I can't remember. There was a loan officer that resigned. One executive resigned, right, Henny?
Yes, it was the person in charge of their construction division. They do a lot of construction loans.
Yeah, resigned. So Henny sent it to me, the Zach's report, reasons to buy and reasons to sell, and I briefly read. So I think we still need to just listen to
I
follow our
think,
heart intuition.
yeah,
Yeah.
I think we should, just because of time, and we have a few more annual reports to go through, we should probably try to get through those and then get to the
Go
voting.
back. Yes. Yes, yes, yes. I was just going to show you so who's next? Let me look
Me,
at the,
me,
oh, okay. Joanne.
because Matt's
Okay.
not here, and
Okay.
I'm going to present PSA and
Elise.
air
Okay.
lease.
Okay.
Okay, okay. So PSA is a public storage. Well, it's a storage REIT. So people rent these storage lockers, store their belongings, and then this company, I think it's like what it's the largest of the storage companies, and but I think all combined, they only have like 15% of the market. These four largest companies, so it's a very there's a whole industry built around supporting storage companies. This company just happens to be one of the largest, even though it doesn't have like a huge market share. We bought this company end of 2017 for $216, and it's currently at $219. So it hasn't been a hugely performing stock for us, but it's one of the companies that does pay a fairly high dividend. Well, I won't go through the ratios because we'll look at the SSG. So for the financial statements, the revenue growth 3% for the quarter, 3.2% for the year, and then the current ratio is 6.1 to 1. I'm not sure. I don't know if anybody can share any insight on this of what we're looking for the current ratio. Does anybody have any insight on that? What the target is? No. Okay.
Jane, do you know Jane? Because she was a CPA.
The current ratio is to see whether we have enough current assets to pay the current liabilities. So the higher the ratio, the more ability to pay for the current liability we have, the company has.
But isn't there some kind of balance that you want so that you don't have a ton of assets and no liabilities?
This is back in the cobwebs of my mind, but
Okay.
it seems to me that it's either a 2 or a 3 to 1.
Okay. So it might be that an indicator that if it's like over that or way below that, that we might be looking at how they're managing their assets then.
Yeah.
Yep.
Okay.
But it looks like they have plenty of money to pay off debt.
Yeah. Okay. And then the historical sales rate was 6.8 over the last 10 years, 5.8, and then it's been going down. So I put the sales forecast. I actually kept it at 5 and 5 for the EPS. Okay. I didn't. Okay, so their SSG, and we'll look at this, is up, and the debt to capital's up. I didn't find any guidance. I find it really difficult to find guidance in the 10K. Has anybody found
Yeah.
guidance?
Yes, sometimes it's not really in the 10K, it can be in the annual report, the glossy report, they may mention that. Also, I found them in their presentations through
Oh,
their
okay.
conference call. Yes.
So I found for the
presentations really helpful, presentations, if you can find.
So the glossies don't come out till much later. Yeah. So anyway, if I find that, like, maybe I'll try to look for that when I'm doing a quarterly report.
See if they have any presentations to investors.
Yeah. Okay. Yeah. I did find something for air lease, but not for public storage. Okay. So they're continuing to acquire. As I said, they're the largest of the companies that do storage, but even then, they're still a fairly small company. So they're continuing to acquire other storage facilities. I think one of the major pieces of news for this company is that their CEO and CFO retired last year.
Oh my gosh.
Yeah, so they were the ones that led, as this says, they led the company to historic highs and expanded their footprint. So it's in their earnings call, in the last few earnings calls, they've said that they've worked closely with this Joe Russell and Tom Boyle, so they feel confident that it's going to continue to, sustain the business. I have this ranked as a hold, and I got this from an analyst that they're a consumer defensive segment. I don't think that, Hanny, this is ranked as consumer defensive in your iClub. But anyway, yes. Were you going to say something?
Well, I was just going to say it's very everybody defines these things differently depending on which, whether you use Morningstar or Value Line or Zacks or what have you. So it's kind of subjective.
Okay. And so I put this comment in there that they aren't, there's inelastic demand, and that the demand will stay constant even in a recession, or because everybody still gets divorced, there's still death, people still move. But Hanny's comment to me was that if somebody's out of a job, they're going to sell everything or stop paying on this. And when I thought about it, I thought some people, when they lose everything, they still want to keep their things. So for $150 a month, they could still have a storage unit with all their stuff in it. I mean, it doesn't seem rational, but just the way people accumulate things and need places to store. So
I only
I'm
said
not one.
that, Joanne, because I used to watch the show Storage Wars
Oh
religiously
yes, I watched that
with
too.
my son.
Yes,
He
right,
was got a kick out of when they opened those lockers up. So
Oh,
right. Yes, I watched that one. I was going to say, $150. That's a lot. I
yeah.
remember I ran a before it was paid like a 50 or something. 150
Okay.
a month. That's a lot.
Oh, and so in evaluating this company, they do use different. It's FFO. I know that instead of EPS, funds from operations. Jay had the same issue when she was evaluating that other,
Hmm.
was it another storage? No. What was that real estate, that REIT that
Oh,
you had?
oh, oh.
What
That's
was
oh.
that?
What's oh? I forgot.
I can't remember, but
Lawyer.
it was another REIT. Anyways,
Yes, it's
we
oh, just
we
oh.
figured out how to, you have to reconfigure the
Yes,
SSG based on
yes,
FFO versus
right.
EPS.
Yes.
So they're actually doing, I mean, they're meeting their projections, and it's just not a high performing company. I think this would be a great company for somebody that's retired and wants to have an investment for
Income,
dividends.
dividends,
Yeah,
income.
income.
Yeah.
Yeah. Let's see. Is there anything else? So I couldn't update the company status. They didn't have their latest figures are on their website, or from 2017 or the end of 2017 for how many storage facilities they have, and they're actually into Europe, and they also do business parks. So let me take a quick look at the SSG. I mean, it's up slightly and parallel, up, and then the debt to capital, they're uh, about flat actually, but it's higher than their 5-year average.
but it's still low.
Yeah. Their current PE is lower than their average PE, so I think we like to see that, right? Because when it's the current PE is higher than the average PE, means it's overvalued. Is that correct?
Right. It is
Okay.
correct, but also depends on the environment, the market right now. A
Yeah.
lot, because December things are went down, so currently it is the PE is
Yeah.
lower than.
But well, my view is that's what you want when you're looking to buy, but holding it and what it shows if it's over so-called overvalued, it means that it's very popular. Then you have to
Okay.
decide whether to keep riding it or sell because it's ended the growth.
Okay.
But you don't want to hold a company that's going down in value.
Okay. Oh, okay. Let's see. So upside down ratio 2.8 to 1. I think the biggest issues are potential price appreciation. It's 11.3 or 9.3. The average, using average forecast PE. So my recommendation is a hold. I know that this has been on the table. I think in one of Hanny's presentations, he thought that we should sell this. So, because it's, and actually on that chart that Hanny showed us earlier in the evening for the Treasurer's Report, I think this is one of the poor performing stocks. Okay, Air Lease. We just purchased Air Lease. It's a company that leases airplanes. So to like the major airlines. Let's see. Their stock price, okay, is kind of it was actually at a high 47.34, and now has dropped to 34.74. We bought it at 37.35. I think there was a slight impact with the Boeing Max incident.
I was going to ask you about that.
Most of the airlines that had purchased those planes took a big drop. The leasing companies or companies kind of affiliated with supporting that were kind of third party were not supposed to have such a big hit because they can have room to leverage themselves out of, because they don't actually and actually Air Lease only owns 11 of those airplanes, although they have had put an order for 168 of them. So I don't know how they're going to be adjusting that. In their earnings call, they said that they were focusing on what they call single aisle airplanes versus wide body, which the wide bodies are the bigger airplanes, and the single aisle are the ones that kind of do more regional flights. So,
Joanne, if I could
yes.
just for a moment, you said they're supply planes to the major airlines. I don't think they do to the United States airlines like United and Southwest and American. They're but overseas, Singapore and a lot of the other so-called major airlines in that area, they supply to.
Oh, okay. Let's see. Okay, so their current PE ratio is 7.6, and we looked at this, that 5-year average is 10.7, and the low is 8.5. So their PE ratio is below the average. Revenue growth, 12.9% for the, the difference in the revenue growth, 12.9% for the last quarter and 10.8% for the last year. Their current ratio is 1.35, so that whole assets to liabilities. So they're putting all, I guess, their assets are using a lot of their assets for their airplane purchases. No decline in free cash flow. And I didn't change the estimates for sales growth or EPS. And the management is even for profit on sales, up on return on equity, and even on debt to capital. Let me change this. Okay, so according to their earnings call, they project that 2019 will be a high growth year where they will be delivering 80 aircrafts, and they are looking at long-term leases. Okay, so what they explained is that maintenance, the leases are dependent, or one of the factors for the leases is maintenance, and some of the regulators are extending the time for maintenance. So that means that they feel that the carriers aren't going to be replacing their planes as often, or in that short amount of time, that because of their expanding that maintenance time. Let's see. Yeah, I have it right here. Maintenance intervals are tied to lease terms. Let's see. As regulators extend the intervals for maintenance, the long-term leases are increasing. They have $26 billion in total committed rentals. Oh, this is the impacts of the Boeing Max. So they had 11 delivered, 168 ordered. Okay, so Consumer Affairs Research found that Air Lease Corp leases a 737 MAX to carriers such as Spirit and Frontier. And I believe those are local, aren't those like regional carriers? Those are domestic regional carriers.
They're U.S. domestic.
Yeah.
Yeah.
Okay.
They're smaller.
Yeah. Air leasing companies have these jets on order, but the stocks haven't been affected like Boeing. The market is saying those companies have time to adjust. So far, 385 aircraft have been delivered, of which 344 are the MAX 8. So my recommendation is a buy. They're still in a as well. We've only recently bought this, so they're still well. Okay, I just wanted to take a quick look at. Let's see. I did do a. Jay, you said the presentations for.
What?
You said to find information on the presentations.
Oh,
Like
yes.
guidance.
Yes, yes.
Air Lease had a really good. And I don't know. Tom? Did you present this?
Yes, I think so.
Do you remember seeing this? Airline economics. Well, it says 2019. I guess you didn't see that, but or you might have. These are all the. They did really well researched about how the airline industry is doing. They went through all the key factors on the industry trends, how passengers are flying, continuing to, like passenger travels continuing, the dollar strength. Okay, I'm just going to quickly go on ahead and show you what. So this is their order book. These are the airplanes that they're ordering, and see that MAX is like the second highest. So
with the Joanne, I don't know. I might want to ask. With the MAX, that's a software problem, right? And I think Boeing will be able to fix that software problem. I don't know.
I've been following it pretty closely since I fly Southwest that has a few.
yeah, you do.
And it seems like it's mainly a software problem, but the software was created because they changed the placement of the engines in the smaller 737s. When they expanded it to the MAX, the 8 and 9, they moved the engines. And so that could be a problem. I'm waiting for reports, and it's going to be months before we get the reports.
One thing that might impact Air Lease with this Boeing issue is that these 737 Maxes have a lot of people were buying them because they have about 15%. They're 15% more efficient in terms of fuel, and so if Air Lease and some of the airlines have been working their guidance based on lower operating cost, that might, if they don't go through with these purchases, or if the changes that Roy is mentioning, which is I think they're going to have to move the engine, the location of the engine, I don't know if that will impact their fuel efficiency. And so that might increase operating costs and then cause a bit of a problem for Air Lease and others that have already done their economics based on those numbers.
Okay. Let's see. So anyway, this is an example of a great presentation for investors. So I would recommend taking. I mean, if you can find something like this on when you're evaluating your stock, well, I like all the graphics. It's a lot more interesting than looking at a 10K. But let's see. Let me look at
that's what I looked at when I recommended OLED and bought it myself.
Oh, you did?
They had great graphics on their website.
Yeah.
Well, one thing about these airline manufacturers, there's only two major airline manufacturers, and I mean, Airbus can only make so many planes, so I don't know, what the customer's alternative is.
Yeah, I think that's a really good point as well, Tom. It's I don't given the long lead time for aircraft to order aircraft, I don't think Airbus is going to be able to replace all of these Max Air. So they're going to have to do something, retrofit the plane or something.
Well, they could go back to the older generation plane, I guess.
So I want to mention something. I've been studying this company, and I really like it. And I went to Yahoo Finance, and I learned that is 28%, over 28% of this stock, Air Lease, is held by the insiders. The people that are running this company still own a lot of stock. And in the last 6 months, they've purchased over 1% more. So that they're insider purchases. And another thing I see that I kind of like is the PEG ratio is 0.25. The 5-year estimated PEG ratio is 0.25. So that means that the sales growth is 4 times more than the PE. So this looks like a bargain to me. And I would hope we would put some money in it.
Okay. Okay. So now, are there any questions for either of these stocks? If not, then we have time to discuss buy or sell.
No. Algonquin.
Oh,
One more.
Annie, I forgot you.
That's okay. I'm happy to go to sleep right now.
Oh, yeah, that's right. This is your time to go. Okay.
Okay, Annie. Where's Annie? Oh,
Okay.
okay.
So I will make this.
Next time.
Okay.
What's that? Sorry. What's that, Tom?
Maybe we should schedule you earlier in the meeting in the future.
We should.
That would be good. That would be good.
Yes.
So I'll do.
I'm for putting him last, so he'll stick around.
I'll do this fairly quickly, and I'm gonna start off with the SSG, and I'll show you why in a second. So I came across this by accident because I listened to the conference call, and I got very confused, and then I called their investor relations department because I thought they were giving out misinformation on the conference call. And then I went back and I looked at the 10Ks and found out that there's an error in the SSG. So if you look at this, it shows that the sales dropped from 1978 million to 1647. In fact, this number is wrong. This should be 15, something like that. So sales are actually, this line should be going up. It shouldn't be dropping. And if you go back and you check the 10K, you'll see this number is not correct. And that was a bit of a surprise because I kind of usually when I do these SSGs, I take these numbers for granted and I assume they're all correct.
Yeah.
So that was a bit of a surprise.
You can make changes in the data, right? You can modify it.
Yeah.
Yes.
No,
okay.
I didn't do that because I just wanted to show you that.
Okay, got it.
Yeah.
Okay.
But regardless, so they have been growing both sales and earnings. What these guys do is they own a number of generation assets. So they have hydropower, wind, solar, and some gas. And then in addition to that, they also supply water to certain communities, and they have assets in both Canada and the United States. They're located about less than a mile from my house. They're very close, their head office. And I actually drive past their office to work every day. But They also own transmission lines, and in a number of sort of remote locations, they have transmission lines that are several, about over 1,000 miles of transmission in some places. They they have long-term power purchase agreements. So what that means is they produce power, they sell it to the grid at some price, and they have those contracts for long periods of time, 5 to 10 years, which means that they have a guaranteed revenue stream. And typically those power purchase agreements have clauses in them that will the price of power will adjust according to inflation, GDP, and things like that. They're quite complicated. They can get pretty complicated, but the bottom line is that they have a recurring revenue stream that also can increase if in certain economic metrics change. So it's a pretty stable business. They have been acquiring both transmission, and I'll just show you down here. So there's a number of acquisitions that they've made during the last year. And
Henny,
yes.
what IPP stand for?
Independent power producer.
Okay, thank you.
So in Canada, less so in the United States, most of the large utilities are government owned, provincial usually utilities, but there is a number of independent power producers, and in the States it's I think there's more IPPs than there are state-owned utilities. I don't know if there are any, if there's a lot of government-owned utilities in the US anymore. But anyways, just going through this thing, you can see that the price as of today is about $11.22, which is pretty close to the 52-week high. The PE ratio is 28, which is pretty rich, a lot higher than the 5-year average. Revenue has been increasing. I put here this 1522, which is the right number, not the 1900, and so revenue has increased by 8%. The liabilities have gone down. Assets have decreased because they've sold off some things and they're buying some things. So I think this year was a little bit unusual because there were a lot of deals that they had made. They bought a couple of utilities and so on, and so I think they'll start going forward. They'll start to see the benefit from those acquisitions. They continue to have an acquisition strategy, and the reason for that is they want to have, I have it here somewhere, but they want to have industry-leading dividends, and their dividend is at the moment is close to about 5%. So it's pretty decent dividend, and then on top of that they have good growth through acquisition. So I won't go through all of this, but basically, they're trending up for the most part in most of the metrics, with a couple of down metrics here. So the profit is down, and I think that has to do with some of the acquisitions and getting the value out of those, because when they take these over, there's usually some capital investment that has to be made, and they don't get all the efficiencies right away. But I think long term they'll do quite well. So I went through the SSG, and I have it as a pretty solid hold. I've put forecast sales and earnings at around 10%, and forecasted high prices is 15, which I think is a little bit low, given that the stock is at 11 right now. But just wanted to be conservative, and especially since the PE is currently 29 and the average is 21. So as far as low price, I just took 20% roughly of the current. So that gives you a hold and a projected return of about 10% per year. So based on the average PE. Any questions?
You know, Henny, when I was studying this company and presented, I like everything about this company except their stock price. As you can see, the historically 10-year stock price, they really have not gone up much, like not even passing $12, I believe. If you look at SSG, the black line, the 52 weeks high and low
Here.
price, stock price.
Yep.
Yeah, so that's the only thing that I just don't understand. I said, why, I hope that I just don't know in the next year, 5 years, if the price will. So basically I'm asking myself, what's next? Right now they're at the 52 weeks high. Are
Yeah.
they going to, how much they can grow?
So they will grow through acquisition. They're still they're only a billion six in sales. So I think that they'll grow through acquisition. Part of the issue with prices with utilities in general is that you have, given where we were in the market cycle, and also the fact that interest rates were projected to go up, and these guys all have assets that are interest rate sensitive. And then on top of that, they're paying a dividend, so that kind of compensates you for the growth.
That's true. Yeah.
Amount at 5%. That's so you have to look at their projected growth versus what you're getting with the dividend.
Right.
But being a utility, they're not going to be they're not going to grow aggressively.
Right. So what I did was, you know how when you purchase some stocks and in your portfolio always have like a little bit money left, like $100, So that's what I did. For $100, what I do? So for this, so I can buy 10 shares, 9 shares with the remaining money which, what I mean, like in your Roth account.
Yep.
So when you buy other holdings, a little bit money left, that's why I buy this company. That's how I do it because it's cheap. Well, when I say cheap, meaning the stock price wise.
Yeah, it's not a not a high stock price. Yep.
Right. Yeah.
Yep. Okay. Any other questions? No.
Well,
okay.
There's two red flags on the bottom there. I'm sorry, I didn't. When you're looking at management, they had, those two, pre-tax profit on sales and return on equity. Well, but they're still up there.
Yeah, those change from year to year based on acquisitions that they make, and if you sometimes when you acquire these things, you have to make there's certain regulatory requirements, so they pump cash into the acquisition to meet certain regulatory requirements. There's also some new laws coming in regarding reduction of greenhouse gases, and for some of their gas generation assets, they'll probably have to do something with those to meet some of those regulations. The only thing I don't like about these guys is that they don't own any nuclear generation, which I'm a big fan of, but that's just a personal thing.
But can they? Is it?
They could if they wanted to invest in the new small modular reactors that are being developed. These are sort of up to 100 megawatts, 200 megawatts, very small footprint, and can generate enough electricity to house or to supply like a small area or.
But then you have a problem with nuclear waste that doesn't disappear for 200,000 years.
Okay, Bernard, you and I need to have a conversation offline.
That's his expertise, Bernard. You don't want to argue nuclear with Henny.
Well,
Let's
want
we've got
to stay friends. Yeah.
11 minutes. Let's discuss the buy sell.
Okay.
Well, let's discuss nuclear waste.
No, we're moving. Okay. Does anybody have any?
Yeah, I move we would buy Air Lease.
Anybody second?
I'll second.
Okay. Discussion.
I think this Boeing thing is kind of overblown, and I think that I mean I would, if we had time, I would consider doing a stock study on Boeing to see if it might be worth picking them up on the pullback here. So I think it's not a bad idea to consider Air Lease.
The last Motley Fool broadcast I heard just a few days ago, they think it's still not cheap enough. It's still not much below its 52-week high.
Yeah, it's pretty high given
It didn't go down that much.
So do we want to put a watch on it?
Boeing? Well,
Sure.
yeah, I'd like to buy Air Lease, but I was just commenting about Boeing, which I guess is.
Oh, Boeing. Oh, I mean Boeing's too high? Okay.
Yes, according
Still
to
is.
what,
Still is. Boeing's still too.
But, I think there is some concern about all that, but like was pointed out, there's a lot of lead time before those planes are even ready to be delivered to Air Lease and the other customers. So hopefully by then, they'll have worked out what they need to do. So this could be, blood in the streets type of thing where you want to, buy now. So I'm a little concerned, but like I think it was Haney said, it was overblown. They're not going to be delivered tomorrow. It's going to be spread out for a while, and so I think the cap size can lift up.
Okay.
So I'm for going ahead with it.
Shall we vote?
So the first one is Air Lease, right? That's what
Yes.
we're doing on?
Yes.
Okay.
We're doing one at a time.
Okay.
I vote yes. I can't find my ballots. Well,
Okay,
let me check.
we'll get you. Does
Okay.
I can
vote
read.
yes.
Ballots are coming. I see it. Joanne, you're not.
I just sent it.
Oh. Are
You see it?
you?
Joanne, is this the email that you sent about 4 hours ago, right?
Yeah.
Yeah.
Okay.
I see Henny, Tom, Roy, Mina, Megumi, not you.
Not me?
Are you using JoJo? Are you using Joanne or Bata?
Oh, maybe I can't. Okay, maybe I should use.
Oh, none of them. Yeah. Well, I don't
None
know
of them
which.
working?
None of them.
I'd like to make a motion to use iClub for voting in the future.
Can we do that with the free? Is it free?
Yeah. Yes.
Yeah.
Yes, it is.
Okay.
do we need to log in or something?
Probably, yes. We should test it out, but I think it would be a lot easier.
Okay. Well, I vote yes.
Okay. So the motion passed.
Okay. Motion passed. Okay.
Oh yeah, motion
We
passed.
didn't specify the amount.
Oh yeah.
It's
So
$1,000.
100%. Oh, so sorry. Yeah. So yeah. What's the amount? $1,000.
Okay.
We have $1,000.
Okay. We have more than 1,000.
I know.
Okay.
Okay, so how about, does anybody have a motion for what was presented? The challenge to Bank of Ozark.
Yes, I would like to motion that we buy PacWest.
For how much?
$1,000.
Okay, and anybody second?
I'll second.
Okay, and discussion?
Now, does that mean this replaces Ozark, or is this in addition to Ozark?
No, that would be a different motion, but I think we could handle two financial companies, and I was in favor of getting rid of Ozark most of 2018, but that one slide shows that it's may have rebounded. So maybe we should have bought more in December, but or January, I guess. But maybe it's, they had some problems, like I pointed out. They lost some, bad loans and at least one key executive left. But maybe now they're able to look forward. So I'd say, let's just deal with the buying.
Okay. Oh, so this is an addition. So
this is PacWest for 1,000.
yeah, PacWest for 1,000. Ready to vote?
Yes.
Oh, hold on. Sorry.
Why does it ask to vote twice?
Oh, did you need to clear?
I did.
Oh, you did clear
Henny,
it?
you are fine. Henny, you are fine.
Yeah, no, I know, but it comes up. I fill it and then it asks me again to vote. So
Because
Oh, you're
it's the
voting
same
for
ballot.
me.
What?
I'll vote yes.
Hold on. We have 5 votes coming and there's 1 no. Let's see. I'm waiting. So 6 votes. Joanne, what's
I'll say yes.
okay? What about Bernard? I don't have to ask Bernard.
Bernard said
So
no.
motion, yeah. Wait, Bernard's no? Bernard, what are you voting for?
Well, that was, if you guys want to buy it at Bank West or something, okay, that's all right. Yes.
Okay. So yeah, motion still carried. Motion passed.
Okay, so we have 1,000 of PacWest and 1,000 for Air Lease.
So yeah, 83% yes, 16%. Yeah, 1 person voted no.
Okay. All right.
Do we have enough people we have a lot of stocks. Do we
Well, I
want
have.
to like 2 stocks, 2 financials to follow?
Wait, say
Well,
that
one
again?
suggestion would be whoever follows one follows both. And then
I'm going to say sell Bank of Ozark.
Okay.
have you ever read the Rhyme of the Ancient Mariner?
No.
How about this? How
We
about
put
this?
an albatross around your neck.
Hey, we are going to have a prospective member, John. So maybe he and I can split. So since well, we can decide. Either
Okay.
he can follow Bank Ozark or I can follow PacWest or
Okay.
vice versa.
Or join it. Just
Yeah,
team. Be a team.
yeah. If he still wants to join us.
Okay.
Maybe he
All
thinks
right.
this is too much work.
Do you know when the quarterly reports due on that?
I
PAC
don't.
W?
For which one?
PAC W.
PacWest?
Yeah.
Oh, I'm not sure actually.
Okay.
Yeah.
No worries. I'll figure it out.
Okay.
Okay.
Do we have a more?
That's
motion?
it.
That's it.
Yep. Okay. So I'm going to stop the meeting, and then we can be open for questions.
Okay, I have to play nurse, so I'm going to sign
Okay.
off.
Oh,
right.
hold on. We have a guest to have a question. How about BA? Who's BA? Is it Boeing?
Yes.
Boeing. Yes.
Oh, okay. So a person asked, a guest asked.
Well,
John?
okay.
Yeah.
We don't ordinarily vote on stocks that haven't been presented.
Right. Yeah.
So yeah. So
Okay.
that would have to be presented.